August was another challenging month for investors, as share markets around the globe lost ground and displayed considerable day-to-day volatility. The falls were widespread and in some cases were substantial in magnitude. America's S&P 500 index was actually one of the better performers, but it was still down by 6.3% in local currency terms over the month. European markets also performed poorly, with the German and French markets falling 9.3% and 8.5% respectively. The UK's FT100 index was also weak, with a fall of 6.7%. In Asia, Japan's Nikkei index was down by 8.2%, while the Hang Seng index in Hong Kong fell 12%. The most closely watched market was the Shanghai Stock Exchange. Its performance during the month was particularly volatile, and despite feverish attempts by the Chinese administration to stabilise the market, it still fell by 12.5% in August, its third consecutive monthly decline. In the 3 months to 31st of August, the Shanghai market has fallen 30.5%. However, this is the same market that increased 13.2% in March and 18.5% in April, so substantial month-to-month movements is nothing new when it comes to this market. The Australian share market was not immune to the weakness globally, with the ASX 200 accumulation index falling by 7.8%, its worst monthly return since October 2008. The weakness was widespread, with all industry sectors losing ground. Energy was one of the weakest performers, falling by 13.9%, as a number of companies reported lower earnings and dividends due to the fall in the price of oil. Bank stocks also underperformed as investors digested recent and current capital raisings by National Australia Bank and Commonwealth Bank. Overall, the MSCI All Countries World Index unhedged returned minus 3.5% in Australian dollar terms in August. Market returns were mixed in the year to 31st of August. The UK was one of the worst developed market performers, where the FT100 index fell by 8.4%. America's S&P 500 index returned minus 1.6% for the year, while Australia's ASX 200 accumulation index was down by 3.2%, which was due largely to the price weakness of resource and energy companies. However, a number of markets have delivered good one-year returns. Japan's Nikkei index increased by 22.5%, while in Europe, the German and French markets returned 8.3% and 6.2% respectively. As for the Shanghai Stock Exchange, despite the pronounced weakness and volatility in recent months, it was still up by 44.6% in the year to 31st of August. Concerns regarding China were the dominant influence on markets in August. Investors have become increasingly worried that China's economy is slowing faster than anticipated, and it is not hard to find evidence that this is occurring. Manufacturing activity has been declining for some months. Weakness in the construction sector remains a key drag on industrial output, and the pace of investment growth continues to decline as China transitions away from a capital-intensive economy towards a more consumer-oriented model. China's decision to devalue its currency during the month not only surprised markets, but was interpreted, perhaps wrongly, as a sign of a more serious economic slowdown. Concerns regarding the outlook for other emerging markets, particularly commodity-dependent economies such as Brazil, Malaysia, Mexico and Russia, also contributed to market volatility.